Hello again. So it's been a while. I'm a little bit late on the video. Last week was when the Federal Reserve met, was Tuesday and Wednesday of last week. So let's talk about this. Okay. Cat's already out of the bag. They cut the rate. Why they cut it, I don't necessarily agree with. They cut it. Powell said he cut it because there's talk of recession, or there's signals of recession. They're slowing down, they're in the global economy, and they're trying to be preemptive about this. They want to be proactive, not reactive. And they've decided to go ahead and cut the rate as a response. I don't necessarily agree with this because, again, we have, as a US economy, we are still doing really well. Our numbers are looking good. There was no reason to cut the rate. Another reason that might be why they decide to cut it is because there are other countries that are borrowing at basically a negative yield, meaning that the investor would buy a bond from, Germany, because we all know they're in negative yield. They buy a bond from Germany, and they're basically paying Germany money to hold that bond instead of Germany paying them money to hold the bond. So why on earth would we be paying other people to hold our bonds when you could get paid, like US could get paid to have people hold their bonds? Like, why would you pay interest to the investor when the investor could be paying you money to hold bond? So I get why they would like to see that happen with the US, but negative interest rates, that's uncharted territory. The only country that's been in it long enough, and they haven't even been really in it that long, but they've been in it longer than probably anybody else, is Japan. Japan's had, at least out of the developed economies, Japan has been in there since the 90s. So ever since the late 80s, when we struck the Plaza Accord with them and forced them to value their currency faster than they should have appreciated it. And then it's pushed them into this situation that they're currently in now. And they've had negative yields for quite some time, at least compared to the rest of the developed economies. And so Germany is there now. They're not deep into the negative yield territory, but they are a little bit into being below zero. So the US is watching this closely, as other countries are as well. But we'll talk about that in a different video. That's a whole nother topic that we will have to get into. But today we're just going to talk about an economic update. So the Federal Reserve, probably it's anticipated that they won't be making any more rate cuts for the rest of the year. The amount of members of the FOMC that dissented from this particular meeting, it was more than the previous meeting. So there were more people saying, hey, we shouldn't cut the rate, we should keep it level. There was one who was the chair of the St. Louis Federal Reserve that wanted to do a 0.5% cut. So that obviously didn't happen. It was just a 0.25%, but there were more members that wanted to do at least a 0.25% move than the ones that, than the number of people that just wanted to keep it level. So hence the movement. So there's that. China. Of course, China. When is China not in the news? I swear. So China has stated that they would like to continue to buy U.S. goods. I've told you guys for months and months and months that they can't afford this trade war. This is why they are wanting to strike a deal with the U.S., have them come back to the table, and really discuss a trade deal. We'll see what comes of that. Who knows what'll happen. Right now, that's, I think, the last thing on Trump's mind. He's got this impeachment inquiry that is happening. Now, this is definitely taking a toll on the markets, because when you are talking about, impeachment of a sitting president, that creates a ton of uncertainty. whether he gets impeached, what happens if he does, who's going to take over, all of this. I mean, we all have the protocols to put into place, but if Pence gets impeached as well, then that's a problem in its own right. We're coming into the election year next year. Even though there would be, the presidential election in November of next year, it still wouldn't matter because this would be happening in between now and then, and the markets are going to have reactions to this. And right now they're having very negative reactions because it creates a ton of uncertainty. And so that's where we're seeing these fluctuations in the markets right now. Anytime you hear the word impeachment being thrown around seriously by Congress, it's going to have a negative impact in the markets because now we don't know how this is going to play out. We can't make predictions. We can't, a lot of business kind of gets disrupted with talk of impeachment for a whole host of reasons, obviously. So that's why I'm like, China is going to have to wait a minute because Trump's dealing with this right now. And so, it is serious because Congress is trying to take this very seriously about impeachment. Now, whether you are pro-Trump or anti-Trump, it doesn't matter. It's all having an effect on the markets. And that's going to affect your portfolios. So this is why it's important for you guys to pay attention to what's happening in the current events and with the markets, because it ultimately will affect your investments, your individual investments, whether it's your 401ks or your brokerage accounts or whatever you've got, even the money markets at your bank, CD rates at the credit union, all of this, the Federal Reserve, the markets, it all affects your individual money and your individual assets. So that is the reason that we're talking about this and why I try to, give updates and kind of educate people on, and not educate, but just give them information on what's going on in the current markets and current climate of the economy so that they can better understand how it's affecting them. Let's see. That's really, oil, after the Iran attack on Saudi Arabia, oil hasn't really moved in big leaps or bounds up or down since then. Saudi Arabia last week said that they could be up to 70% production quite quickly after the attack, which means the attack wasn't as big as the media was making it out to be, if they can be back up to 70% production that quickly. So you can take that for what it's worth. That's really about it at this point. As always, if you guys have any questions, put them in the comments below. I promise I will talk about negative yield and inverse yield curve. I will do a video on this probably sooner than later because I've been saying it for so long, but we will discuss it because it does have significance. And we'll talk about how that impacts you individually. All right, until then, I will talk with you guys later.